Hi, everybody. Today we are going to dive into one of the most important retirement topics you need to know about. How is your Social Security benefit determined? Before we do that, please take a minute to click subscribe if you want to keep up with all of my latest personal finance content. And with that, let's dive right into it. All right, so when it comes to calculating your Social Security benefit, let's take our time and go through this one step at a time. So, first, the important question to ask yourself is, are you going to qualify for benefits? And the good news is that almost all American workers do. So to qualify, you need to have a total of 40 Social Security credits. To earn one credit in 2022, you have to earn at least $1,510 for a calendar quarter. Or if you multiply that by four, you see that's a little over $6,000 a year. As you might imagine, most workers meet those criteria. And in previous years, the amount was even lower because of inflation. That number adjusts upward every year. So as long as you have at least 40 quarters where you've earned, or 10 years where you've earned at least the minimum amount by Social Security, you will qualify for benefits. So with that, so how is your benefit calculated? So the Social Security Administration, or SSA, they keep track of your earnings every year. You can request your work record on your latest Social Security statement at ssa.gov. And each year there's a maximum taxable amount of earnings that are counted. For 2022, that amount is $147,000. So anything above that amount, you don't pay Social Security tax on. That's a good thing, but it's also not counted when determining your benefit. This number changes with inflation every year. It will probably jump up significantly in 2023. And in previous years, it was considerably lower than it is now. So when you're ready to claim your benefit, the Social Security Administration indexes all of your earnings for inflation. In other words, money that your salary in the year 1998 has had a lot more purchasing power for the dollar than it does today. So the Social Security Administration tries to level the playing field and index all of the previous years for inflation. Once it does that, your 35 highest earning years are considered in the benefit calculation. So the Social Security Administration looks at every year of your earnings, all the way back to when you had a teenage job at a fast food restaurant, all the way until the year before you retire. And the top 35 years adjusted for inflation are then considered. If you've worked less than 35 years, zeros will be used in the calculation in place of any missing years. Most Social Security retirees have worked 35 years, even if some of that was part time work. But if not, they will use zeros in the calculation. So then your 35 highest earning years are averaged together and then divided by 12. This gives something called your average indexed monthly earnings, or AIME for short. And don't worry, we'll get to an actual example of how this works later on. So if you're confused, that's okay, because this is kind of a confusing calculation method. I promise we'll actually put some numbers behind this later on in the video. So then your average index monthly earnings, or AIME, it's then applied to a formula to determine your benefit amount once you reach full retirement age. This is known as your primary insurance amount, or PIA. So we'll get to what Social Security retirement age means in a minute. But if you wait until your full retirement age to claim your benefit, this is how it's determined. The formula changes every year. For 2022, here's the formula. You can see it on your screen right there. 90% of the first $1,024 of average index monthly earnings, 32% of the amount above that 1,024, but less than 6,172. And if there is any amount of average index monthly earnings above $6,172, that gets a multiple of 15%. Those two figures there, the 1,024 and 6,172, those change every year. Those are known as the Social Security bend points in the formula. The percentages don't change. Those would have to be changed by Congress to change the 90, 32, and 15. So let's look at an example of how this works. So let's say that after the Social Security Administration looks at your indexes all of your earnings for inflation, and looks at your top 35, your career average is $60,000 a year in earnings. Dividing this by 12 gives you an average index monthly earnings of $5,000. So just to kind of refresh, here's that benefit slide again. 90% of the first 1,024, 32% of the amount above that, but less than 6,172, and 15% of the amount greater than 6,172. So if your average index monthly earnings was $5,000, that 15% multiplier won't apply to you because you don't have average index monthly earnings greater than 6,172. So you can forget about that last bullet. And in this case, you can see your Social Security benefit, your PIA, initial monthly Social Security benefit, would be calculated as 90% of 1,024 and 32% of the rest, which is $3,976. Add those two numbers together, there's your 5,000 in average earnings, and apply those multipliers, add them together, and you get a total initial monthly Social Security benefit of $2,193.92. But wait, there's more. Remember, this calculation is for your Social Security benefit at your full retirement age. That you would have to wait until exactly your full retirement age, no sooner, no later, to get that exact benefit. And even then, you would have to take into account cost of living adjustments that happen between now and when you retire. So your full retirement age for Social Security purposes can be as low as 66 years or as high as 67 years of age, depending on when you were born. For most people watching this, you were born in 1960 or later. If you're worried about how your Social Security is going to be calculated, your retirement age would be 67 years. If you are closer to your full retirement age now, it might be 66 years and a few months. So there you can see on your screen, based on when you were born, what your Social Security full retirement age is. So if you claim early or late, you can claim your Social Security benefit anytime between the ages of 62 and 70. If you claim early, your benefit will be permanently reduced. If you claim your Social Security benefit late, your benefit will be permanently increased, and here's the rules. So if you claim Social Security early, meaning before your full retirement age, your benefit will be permanently reduced. For every year you claim before your full retirement age, your benefit will be reduced by 6 2/3% for up to 3 years. So if you claim 3 years exactly early, your benefit would be reduced by a total of 20%. And beyond 3 years, as early as age 62, you would be looking at a 5% reduction for each year beyond that. Now, those are prorated monthly. So even if you claim your Social Security benefit a couple months early, it would be reduced. But the kind of converse of that is if you're, say, 62 years old and you kind of want to claim your Social Security benefit now, waiting even a few months can have a meaningful impact. So keep that in mind when you're deciding when to claim. And on the other hand, if you wait till after your full retirement age, your monthly benefit will be permanently increased. For every year after you reach full retirement age, your benefit will be increased by 8% per year until you reach age 70. So if your full retirement age is 67 and you wait until 70 to claim your benefit, it would be permanently increased by a total of 24% over that primary insurance amount. So keep that in mind when you're deciding when to claim. There are obviously other factors besides your age that should play into the equation. And it's also worth mentioning that in no circumstances is it worth delaying Social Security until after age 70. So using that calculation, using our previous example of a primary insurance amount of $2,193.92 that we saw on this a few slides ago, and a full retirement age of 67, if you choose to claim at age 62, your monthly benefit would be about $1,536. So that's a pretty big reduction. But on the other hand, if you waited till age 70 to claim, your monthly benefit would be $2,720. So because Social Security is such a big part of retirement income for the majority of Americans, it's really important to know how the early and late Social Security benefit reduction and increase works, so you can decide what's best for you and determine how much retirement income you need. Because remember, Social Security is the only inflation-protected source of income that most retirees have. So it's really important to make sure you're making the right decision for yourself. So fortunately, the Social Security Administration does the hard work for you. They do the calculations, they keep track of your earnings, and your Social Security benefit is automatically calculated. It's helpful to know how it works, but you're not going to have to actually calculate yours yourself. You can view an estimate of your retirement benefits based on your actual work history. I checked mine. It still has the earnings from when I worked at Burger King in the mid 90s in high school. Um, on your most recent Social Security statement, you can, if you haven't done so already, you can open a My Social Security account on ssa.gov. It's free to do so, and you can view all of your Social Security information electronically there. So, highly recommend doing that if you haven't done so already. Hopefully, you found this video informative about your Social Security benefit calculation. And please feel free to reach out in the comments if there's anything that needs clarification or if you have any other questions. Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.